Hey, what's going on, everybody? Thank you for tuning in. So this is the sprint review. So this is a live stream that I do every couple weeks. It's focused on different personal finance topics that relate to tech professionals. And so, quick introduction for me. So my name is Mike Zung. I'm a certified financial planner, as I'm like so easily displaying in the background there. I'm the owner of a fee-only firm called Java Wealth. I'm based in Kansas City, but I work with people all across the country. And then basically, the focus is on tech professionals. Usually, we talk about equity compensation stuff, but today, what we are going to do is we're going to be talking about something that comes up a lot in conversations with a lot of my clients. So I figure it's like, okay, well, one, let's talk about it, and two, let's get someone that really knows the space. And like I was saying, so what we're going to be talking about today is real estate investing. So we're not just talking about our primary house. We're talking about, okay, we have some extra funds that we want to use in some other way. And so real estate, like investment property, is something that comes up a lot. And so I'm super excited to have my guest Cynthia Meyer on. So Cynthia is someone that we met maybe it was a couple of years ago, doing a video thing. So she specializes with real estate investors, and so I figure that she would be the perfect person to have on. Really, she's going to be teaching me a lot of stuff too. So without further ado, without me blabbering on, let's welcome Cynthia on. Cynthia, how are you?
Oh, Mike, hey, how are you? Good morning. Thanks so much for having me on. It's a great podcast. I've been enjoying listening to it, and I'm looking forward to our conversation today.
Yeah, definitely. Okay, yeah. So before we get going, how about just give you a little bit of space to introduce yourself? You know, where your firm's located and what you do.
Sure. So I'm Cynthia Meyer, as Mike said, and I'm a rental property business owner and a fee-only financial planner. And I work with rental property owners and vacation property owners who are building their rental property businesses.
Okay.
And
Okay.
My firm's called Real Life Planning. I'm headquartered in Gladstone, New Jersey, which is about 30 miles west of New York City, so in the New York metro area. But I have a virtual practice, and I work with clients all around the country. So we're licensed in we have many clients in New Jersey, obviously, but also Texas and California and some different states.
Yeah. Yep. Yeah. Okay, yeah. I guess maybe we can talk a little bit about California real estate in particular. It's a little crazy. Yep.
It's a totally different world. Yeah.
Right. Yes, exactly.
So one of the things that I wanted to make sure that I told you, because I'm not sure we ever really talked about it, is how did I get started, both as a real estate investor, as a financial planner who works with real estate investors.
Yeah.
And so, I'm a first generation real estate investor, and so is my husband, whose name is Steve. And during the Great Recession, right, we were actually expats at the time. We were living overseas for a work assignment for Steve. And we had sold our house in California, and we really wanted to get back into the housing market in the United States. And at the time, we thought we were going to be expats for longer. So we started to look around for investment properties, and we had seen so many people in my work as a financial planner. I've been a financial planner since 1997. That lots of folks who had really successful, well-diversified portfolios owned both securities and rental property.
Mm-hmm.
And so that kind of put the bug in our ears, so to speak, to think about it. And we started by buying, single family homes and small multifamily properties in good neighborhoods with good school districts. And over time, we saved and reinvested all our net rents from those properties. And we just kept buying more properties. And eventually we got to the point that allowed my husband to leave his corporate job in reinsurance completely and focus on real estate, and then also a little bit golf. And it allowed me to leave my corporate job in workplace financial wellness and start Real Life Plan to help other real estate investors, hopefully to mentor them to try and do something similar.
Okay. So then, in a way, it wasn't a thing. It was as much that I wouldn't say that you stumbled into it, but maybe there was a little bit of life situations just kind of led you into the real estate investment world.
That's right.
Yeah.
And for those of you who were investing during the Great Recession, right? There was a point where S&P 500 went down like 45% in a year.
Right.
It was jaw dropping, right?
Right.
And of course we've had a great recovery since then. And there was a very different real estate market at the time than we have now, and hopefully we can dig into that a little bit, because what it was like then is not what it's like right now if you're a new investor.
Right.
But we just really wanted to be more diversified, right? We wanted to be more diversified. We wanted to be in something that was inflation adjusting, or at least correlated with inflation. And so that's how we got into it. And at the time we were looking for metro areas where the rental homeowner relationship was upside down. So what that means is that it was cheaper to buy a house if you had the capital than it was to rent a house. So that was a great time, to enter the real estate business and to build a portfolio. Now we are not in that time right now. Right. Now in many metro areas, you mentioned California as an example, right? But Seattle or Portland or Boston, right, are another good examples. Austin, maybe. It's actually cheaper to rent than it is to buy. So we're in a slightly different market right now.
Yep. Yeah, definitely. And I guess maybe, this just happened out like just almost dumb luck in the timing of what we're talking about, right? Where, because right now, just in these last few months, from a stock market perspective, from a securities perspective, like that's definitely going in the opposite direction from the real estate market, right? So just kind of showing just a very quick object lesson of the diversification of like money that you have here and money you have here, that they're not they're not being directly correlated or anything like that.
Right, sure. So real estate can be zinging when the stock market is zagging, or vice versa, right? So incorporating real estate as an asset class, if to people who are securities only investors right now, can really help. It won't completely smooth out the volatility in a portfolio, but can really help manage those ups and downs of volatility in a portfolio. And so that's why you see, for example, a lot of hedge funds and pension funds and things, insurance companies, they're including an allocation in real estate to their overall institutional portfolio because of that very reason. Right. Yep. So one of the things that's really interesting right now is, we're hearing in the news so much about inflation, which of course all of us are worried about what this means for our personal portfolio. But one of the largest contributing factors to inflation is housing. So housing is 40% of the core CPI, the Consumer Price Index. And I'm oversimplifying a very complex situation here, but basically what we've got happening is that we have early career adults who are what's called household formation, right? So they're meeting their person, they're getting a good job, they're having a kid, and they want to buy a house. But we haven't been building enough houses as a country. And so there's about a 6.8 million household gap between the people who are forming households and the houses that are available to buy. Now, some of it is because of COVID, and we've got these younger baby boomers who are not retiring as soon, or maybe they don't want to leave, because they don't want to sell their house during COVID. So there's more contributing factors to influence this question. But there are a lot of folks who would like to buy a house, can't buy a house, so they're renting. So we have more renters that are also pushing up the price of rents. And so that's contributing to inflation, but it's also for people who are on the landlording side, right? It's a nice time to be a real estate investor, right?
Right.
So that your customers, your tenants, are probably paying you a little bit more every year
Right.
over time.
Right. Yeah. So and actually, yeah, just from yeah. So it seems like as much as anything, it's gone. It's talking about it's gotten into the whole supply and demand, right?
Mhm.
Where the demand has gotten so high, but yeah, there's not enough houses being built, so it's driving up the prices. I actually did a
Mm.
live stream last fall with another advisor, Keith Spencer, where we talked about where it was just like, is now a good time to buy a house, right? And so we're trying
Mhm.
to talking about the housing market. And it was the same, it was a similar story back then. I think there was a stat that says that there were more licensed realtors than there were houses on the market at the time.
Wow, that's a
Yeah,
powerful stat. Yeah.
right. I don't know if that's more about the housing or the fact that the number of realtors that are out there. so, so yeah.
Well, was so thinking about real estate investing, I want to talk about in general how there are a few different areas, right?
Hmm.
Before maybe we could talk about the whys of investing in real estate.
Okay, yeah,
But
yeah, that'd be good.
the first question, like let's say uh, that you are thinking about, should I be an investor,
Right,
direct investor in real estate, right? So the first question to ask yourself is, are you hands-on or hands-off, right?
right.
So if you're some people are, they're watching Flip or Flop on HGTV, and they're watching all these decorating shows, and they think, oh my gosh, I want to get in, I want to take that hammer and break down walls and renovate stuff, and tear down the cabinets,
Yeah,
and they have got an artistic or creative impulse, right, to get into something and create it, make it more beautiful, and create value that way, right? So that's
yep,
that's an example of a very hands-on real estate investor. And some people are really hands-off, right? They like the idea of real estate as a diversifier or as an asset class in their portfolio, but they don't want a landlord full-time. They're definitely going to want to use a property manager, maybe even an institutional manager,
right,
to get exposure to that asset, right?
right, right,
So if you're super hands on, right, then direct investment, there are avenues to go. And if you're super hands off, there are also ways to incorporate real estate into the overall portfolio. So it's not an all or nothing thing about, oh well, should you buy a rental house, for example, or
right.
be a vacation property owner, which is super hands on.
Right, right. Yeah, I think maybe I'm stereotyping the tech crowd, but most probably aren't really into swinging hammers very much. So I know. Speaking for myself, there is not a single ounce of me that's like, oh yeah, I totally want to go in and be the one doing this stuff and yeah, and like actually getting my hands dirty with all that stuff. It's just like
Yeah.
that's just
Yeah.
I just wasn't cut from that cloth, right?
Uh, and it's a great thing to know about yourself. Like, how
Hmm.
much time do you have to devote to this as a
Right,
project? And thinking through these issues up front, right, before you decide to say buy a rental property, because it is a business, right? Direct ownership of
right,
property is a business, and just because it's treated for most types of real estate, it's on Schedule E of your tax return as passive income and loss, right?
hmm,
But you still have to work in it, right?
right.
Somebody has to work in it. So knowing that upfront is very useful.
Yep.
Now,
Yeah,
in our
that's.
situation, uh, oh, go ahead. Sorry.
Oh well, no, I was just like whenever you because you mentioned
Yeah.
how it's passive income on Schedule E, right? And so that was
Mhm.
something that I think it's a common thought that it's like, hey, getting into real estate, it's completely
Mhm.
passive income, and so it's just like you just kind of set it and
Mhm.
forget it, and then you don't have to worry about it, right?
Right, like an index fund. Yeah.
Right, right, right.
Yeah.
So yeah, I mean, but I guess just to that end, like what you're saying is that it's like, well, it's
Mhm.
not like there's still understanding yourself and figuring out how much work you're wanting to put into it,
Mhm.
and yeah, so how passive do you want to be, right?
Yeah, yeah, that's an excellent point, Mike. So in at Real Life Planning, we work with people who are trying to build and scale their real estate portfolios, right?
Okay.
So, they may have a few properties, or maybe they have, 6 or 7 properties, and they would like to get to the point where they have enough net cash flow coming from their investments that they can go work optional, right? So,
Right.
in now, not everybody loves the term financial independence. The people that we work with are they're all about that, right? They love
Right.
the idea of getting to the point where if they want to step away from their corporate job, they can. They may not want to, right?
Right.
But they like the idea of just having these multiple sources of income, right? So
Hmm.
that they can feel that sense of financial freedom. And it takes a while, right? Like real estate has a long cycle. It's longer than the business cycle. And so you have to be, willing to wait it out, maybe, 20 years or so before you could get comfortably to that point, right?
Right. Right.
Um, so interestingly, there was, I think it was last year that Bankrate did a study, they did a survey, and they found that 38% of millennial
Uh,
participants who were surveyed preferred real estate as an asset class for growth. And that's a big, big
yeah.
mind shift, right?
Yeah.
From previous generations. So I think what we are seeing in general, in part perhaps because of real estate as entertainment, right? Like we have all these
Right.
channels with real
Right.
estate as entertainment, and people have learned a little bit something, and they think, "Ooh, this sounds fun. This sounds profitable. This sounds interesting, and I would like to do this too." Um, eh, 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 but we are seeing shifts happening in that,
Hmm.
where just like people learned how to trade their own portfolios inexpensively, or work with a fee only advisor and not pay somebody a commission to buy or sell a stock, for
Right.
example. And we're seeing the same sorts of trends in the real estate space, and that has not even begun to completely work itself out yet.
Right.
So, it's always an interesting time to be a real estate investor. People always need somewhere to live and run their business. I mean,
Right.
it's a good thing to be in, I think.
Yeah, 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 definitely. That is really interesting how just that trend that goes towards it, and yeah, just wondering how much of
Hmm.
that is the HGTV shows and that kind of stuff, and I guess
Yeah.
bigger pockets is a big, that's gained a lot of steam. Where it's
Hmm.
just like I think it's just more and more
Hmm.
people are becoming more and more educated whenever it comes to like,
Hmm.
hey, real estate as an investment.
Hmm.
So
And I love that you mentioned bigger pockets, because that really has been a community that has democratized the educational information about different aspects of building a real estate business.
right,
Uh, and they've got a zero cost, anybody can just participate in their forums, and then they've got some
right,
paid memberships that are not that expensive, and it is a wonderful source of research and information from peers. And
hmm,
so a lot of folks who were trying to do this, 15 years ago, might have found themselves in some hotel room and getting a big pitch for a 40 or $50,000 course, right? And
yeah,
now
yeah,
they can go find a similar information, for free or cheap, right?
right.
You can't necessarily get a mentor that way, but it's wonderful how there's so many investors are willing to share their experience and help other people learn how to do this.
Right, right. Yep, yep.
So what? I, I'm curious, what would you say are the primary reasons to invest in real estate? Because, I mean, your folks are asking you this all the time, right? Should I buy some real estate? Right? Like, what do
Yep.
you say?
Yeah, so I mean, really, from the main stuff that I see, right, especially
Hmm.
from I guess I should say my community, right, from this tech community.
Hmm.
So there's a lot of you're really involved in your job, and a lot of times they have a lot of stock compensation, right, and so with
Well.
that. at least a lot of the people that I'm working with, where they're going through a liquidity event where they have where basically they're able to start selling some of their equity that they have in their company. And so what comes along with that is sometimes a small, sometimes a large windfall of cash, right? And so then it's just kind of thinking of it's a natural time to step back and say, okay, I have this now. Where should I deploy it, right? What should I do with it, right? I don't know if they'd say where should I deploy it. That sounds pretty, I don't know. It sounds kind of official, I guess.
But that's a really evocative word, though. I like that.
Yeah. Yeah, but yeah, it's like because I mean, it is about being really intentional about what you have, and just so that it doesn't just get like gradually squandered away throughout the years. And so it's just a common time to think of like, okay, I could either put it like back into the market, to the stock market, right? There's obviously things for like what do I actually care about, and the things that I need to do right now. Maybe people are thinking about buying their own personal, like, new primary residence, right? But then above that it's just like, okay, well, maybe it would make sense to actually start to, like what we were saying, to diversify to where it's not just like I was already in this one single stock, right, which was my company, and then I could either just go into the rest of the market, or that you can carve off a part of that to say, okay, let's get into real estate, right? And as far as the things that I hear a lot of why people want to do that is, similar to what we were talking about, where the seeing being able to do these, like whether you're flipping or trying to get that passive income, or really just having something that zigs whenever the market zags, right? So that you have that. So and then actually, this is where I'd kind of turn it over to you too, as far as like there's a lot of tax benefits that come into real estate investment. But whenever
there are.
Yeah, go ahead.
Oh no! Hey, I'm from New York, right? So we believe in over talking. I have to be careful not to interrupt other people. It's a sign of engagement.
Yeah. Yep. Yeah. I on a side note, I actually just listened to a podcast that was talking about that, where different regions.
Oh, really?
Where different regions actually have different expectations of how much of a pause to have in between, like during a conversation. So and they specifically talked about, like, New Yorkers will like they'll start like talking over and finishing your conversation and then keep going, right? And that's just kind of and it's totally just the way that just the vibe that they have, but it's not meant in any sort of other like bad way or anything like that. So just a complete side note for side note for everybody.
Little detour into sociolinguistics, right? But I think you're right. Yeah, it's something. When I used to live in California, and I would find that I actually spoke more slowly when I was living on the West Coast, right? Because everybody was toned it down a little bit. I did less over talking. Now that I'm back in the New York area, right, I find like about 80% into the sentence, I'm like, jump right there. So,
Yep. Yeah, I'll put the link. It's a Hidden Brain episode. So.
Ooh, that sounds fascinating. Well,
yeah.
so you mentioned, Mike, about the tax benefits, right? And the primary tax benefit to owning income producing real estate in directly, right, like as your taxable portfolio, is that just like any other business, you can depreciate the assets used in the business and take a depreciation expense against the income produced in that business. So for example, a rental property can be depreciated over 27 and a half years. And so we think of depreciable property, right, as stuff that wears out, right? Like think of the machine in a factory. But in fact, a house doesn't, you're going to have to put some money into it over time. It has carrying costs. But, that depreciation expense is a paper loss for the most part. and you're taking that against your net rental income. So if you have, for example, $5,000 of income and you have a depreciation expense of $3,000, right? Then Uncle Sam is going to look at that like that you only made $2,000.
Right.
So that's a primary tax benefit. Another benefit, which all of the listeners who are homeowners can take advantage of, is if you are house hacking, for example, living in a property and that has multiple units, and then you rent the other units to help pay your mortgage. So when you sell that property, part of it can be deferred in what's called a tax deferred like kind exchange, a 1031 exchange. People may be familiar with that. And part of it, you may use the Section 121 capital gains tax exclusion on the sale of a primary residence, right? So some people are serial renovators, right? So that's the hands-on investor who really likes to get stuff done and make it beautiful. Has some contracting experience, is handy, might buy a property that's semi-distressed, fix it up, add value, sell it, and move on to the next one. And so if they've lived in that home for 2 out of the past 5 years, right, they can exclude up to $250,000 per person in capital gains, right? So a married couple, 500,000. Now, as we know, we're not giving tax advice here. This is just general educational stuff, but it's good to know about it and think about it in advance to see if it contributes to your strategy.
Right. Yeah. I'll do the disclaimer at the end. I was supposed to do that at the beginning, but we just kind of blew right into it. So actually, here let me back up just a little bit as far as, because there were a few things that you said in there that are really good things to know, and just want to make sure that people understand. So I guess first, something that would apply to every homeowner, right? For your primary residence, what you're talking about is that exclusion amount, right? And so I guess maybe just to back up a little bit, can you talk a little bit more about what that is for a primary homeowner? Because I found that there's a lot of times that's happened, and I've talked to people, and it's like, you can do that, and they're just like, what, seriously? Okay.
They didn't even know. They didn't even know. And so this is, I'm just going to put a plug here. And again, I'm not a CPA, right? I like you, I have my certified financial planner. But having if you're, as your wealth grows, right, using a tax professional can just help you optimize in all sorts of ways, right?
Right.
So hopefully, if you're selling an appreciated piece of property, right? Like, so let's say you're in a highly appreciating place like Washington State or California or Oregon, or you're selling a property in, parts of Texas or Miami, and you've got a large capital gain in that portfolio. In that property. If you've lived in that property for 2 out of the past 5 years, you're probably going to be eligible for what's called the capital gains tax exclusion on the sale of a primary residence, which is you can exclude up to $250,000 in gain per person, right? So $500,000 per spouse, and so that can be pretty powerful, and any homeowner can take advantage of that. You don't have to be renting the property. You're not renting the property. It's your primary residence. But if you're the kind of investor, as we talked about, who wants to move in somewhere, make it beautiful so that you've added value, so that there is some appreciation, right?
Right.
And then sell it. That's called a serial renovation real estate strategy, right? Where you're going to do that, and then you're going to move every, no more frequently than every 2 years.
Right. Yeah. In order to do that, in order to qualify for that exclusion, that's like, so you're moving to a place, you're living it for 2 years, and you're renovating it, and then once you get past that 2-year period, then you can sell it, and then the gains, I guess, for a couple up to $500,000 can be excluded. Right.
Yeah.
Okay.
Yeah.
Okay.
And I think I want to say here, because I'm not sure everybody understands the difference between what are real estate returns that are related to just normal inflation, and what is appreciation. Right, so inflation is when the price of the property or the amount of the rent is keeping pace with the cost of living, right? Appreciation is when there's more buyers than sellers, right?
Right.
So what we've seen in, let's say, the Bay Area in California, for example, there aren't enough starter homes for people, right? And so there are more buyers than sellers, and that has way driven up the price of real estate in the whole Bay Area. So.
Right. Yep. Yeah. That's a good point. And I guess maybe just to kind of close out that loop. So we have that exclusion, but in the scenario, like if you were in California and you sell your house and the appreciation is actually above and beyond the exclusion amount, then how does the rest of it get taxed?
Oh, great question. So generally that's going to be considered a capital gain, right? So if you've owned that property for more than 366 days, right? Which, if you've owned it for 2 out of the past 5 years, you would have, then it's going to be treated like capital gains property, right? Just like if you've owned a stock for a long time, right? And so the difference between, and I'm really simplifying here because, obviously you're going to want an accountant to help you with this, but the difference between what you sold it for, what you paid for it, plus, any capital improvements that you've made to the property. Is going to be taxed at the capital gains tax rate. In this situation, you'd be paying the net investment income surcharge. And then each state taxes capital gains differently. So California doesn't have a special capital gains tax rate on the state level.
Yep. You can't forget about state taxes. People that's always that. A lot of times that's just a second. It's in hindsight, or it's something that's not really top of mind. But yeah, definitely have to think about that. But yeah, and then also just from that capital improvement side of it, where that it's like, hey, if you're making these improvements to it, then you're, I guess, I don't know how to say this without getting into the technical terms, but like you're increasing your basis, right? Like what the amount that like your kind of your floor whenever you're talking about your gains.
Right. So to talk a little bit more about the benefits in general of moving not just from a serial renovation strategy, but to actually owning investment property that you don't live in, right? That you are renting to somebody else. And to start with, let's just talk about plain vanilla rental property, right? As opposed to vacation property, because that's kind of its own thing. So there's the possibility for consistent cash flow, right? And I always like to say, right, that cash flow is cake and appreciation is frosting, right? And you don't just eat frosting, or at least that's what I would tell my kids, right? You don't just eat frosting.
Yeah, you haven't met my kids.
I think there are people that could argue with me that they like frosting, but so the most important thing obviously is that you have a property that it has positive cash flow for you before depreciation, right? And real estate has carrying costs, and you as the investor has to pay those carrying costs no matter what, right? You're still going to pay your property taxes and insurance and your mortgage payment and the electric bill if the tenant isn't paying it, right? So cash flow is the most important consideration in a good investment, obviously, and is also one of the great benefits of owning real estate, right? You can use that cash flow to reinvest in new properties. You can use it to live on. You can use it to diversify into other areas, right? So all sorts of cool things with cash flow.
Yeah, so I guess maybe just pausing right there. So whenever you're talking about that, so at the beginning, whenever you were talking about whenever the market was underwater, or like whenever the investments were underwater, so that is that another version of what you're talking about here, where like if there's the carrying cost, that's the mortgage, the insurance, and all that kind of stuff, and the utilities. So basically that's one number, and then there's the rent that's coming in. That's another number, and it's just making sure that rent can cover all the carrying costs and then some, right? And so that it's not
and then
underwater.
Some, right? Yeah. And there's a guideline or heuristic, right? A rule of thumb in rental property investing is called the 1% rule. And now it's not really a rule; it's not a law, and it's actually very hard to do in this current market environment. But the idea is that, in general, the kind of first screen on evaluating a rental property investment is, can you get 1% of the gross purchase price plus renovation, right? The amount it's going to cost to put that property in service as a rental. Can you get 1% every month or better? Now,
Mm.
Housing prices are so high right now that in most areas of the country that is not achievable without a major, buying a majorly distressed property.
Uh-huh.
Uh, so, so now the 1% rule is looking a little bit more like the 80 basis point rule, or 0.8%. But that will change going
Yeah.
forward, right? Like it just because it's like that now doesn't mean it's going to be like that in the future, right? Like you still need to make sure that at the end of the day, right, there is some net money left over at the
Right.
end of the month
Right.
after you've paid all those expenses, right? Otherwise, it's not a rental property, right?
Right.
The point of a rental property is to make rent.
Right.
uh, so certainly having potential for price appreciation is also, a very valid reason for real estate investing, and so that's what the renovator or the flipper does, right? Which is a super hands-on type of real estate investing, as we mentioned, is not looking for cash flow from the property, but is trying to build value into it and then turn around and sell it,
Right.
hopefully for a much higher price than what they paid for it. So.
Right, right. Yeah, yeah. That's a good point as far as because I mean maybe it's just my own misconceptions, but thinking that a lot of people whenever they're talking about getting into real estate, that they're just thinking of increasing home prices. That it's just like I want to
Yeah.
get in and
Mm.
that and not really thinking as much from the cash flow perspective.
Mhm. Yeah. And this represents my personal philosophy about rental property investing, right?
Right.
And not everybody agrees with me. Some people will be happy to buy something where they have some net carrying costs, but they think that they have some strong appreciation potential. But for me, that's too, for me personally, that's too risky. So
Right. Right. Yeah.
I
Okay.
want to at least
Well,
cover my costs. Yeah.
yeah, yeah, yep. Okay, yeah, that makes sense.
Yeah.
So,
Yeah.
actually, I think I'll shift just a little bit as far as
Mhm.
just like maybe from a like a practical or role playing perspective,
Mhm.
to where it's like, okay, so now like I'm an individual that like I don't have any real estate, like I don't have any
Mhm.
real estate, but I have some cash flow that I could possibly get into it.
Mhm.
So I come to you and I say, hey, Cynthia, I want to get into investment property. Like,
Mhm.
where do I start?
Okay. So I think so. We talked about the sort of asking yourself if you're hands on and hands off, right?
Okay.
It's probably uh, uh, the first and second questions I would say is the first question is, do you have the funds available for, the cash available for the down payment, the closing costs, and your initial expenses?
Okay.
And in general, um, real estate is expensive. Now, even if you're buying in a less expensive area, I mean, if you've bought a house before, you need it, you need a down payment. You need to pay for the cost of the transaction. You may have to put some money in to renovate it before you can rent it, or rent it for what you want it to. You
Right.
may have some legal costs if you're forming a corporation, such as an LLC.
Hmm.
And then you're going to have a rental property emergency fund, right? You need business cash reserves to
Hmm.
cover the cost of the property in the initial period if it's not occupied, and then at least 6 months worth of expenses is what you should be aiming for in the
Right.
long run.
Yeah. So it's like an
Um,
emergency
yeah,
fund for specifically earmarked for this new
this
rental
property,
property.
right? Yeah,
Okay.
and it may
So
take a little while to get there, right? Like
right.
if you're buying your first rental property, you may not have that all up front, right? But
Right.
but
Right.
as a real estate investor, the 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 risks are highly concentrated in the first one or two properties, right? Because so for example, we have 15 doors. Um, and so the likelihood that all 15 of our tenants not paying rent at the same time
Right.
is pretty low,
Right.
right? Whereas if you just have one rental property, that the probability of that tenant not paying rent is actually pretty high, right?
Right.
It can take a while to turn over the rental property in that situation, right? So there are a lot of legal things that you have to make sure you file them correctly, and
Right.
uh,
Right.
so you do need some cash. And now, uh, they're thinking about it in two different ways. If you are that person in tech, right, who is looking to diversify after a liquidity event, and they're going to use a property manager, for example, they're looking for something
Right.
turnkey. that person is going to put down 25 to 30% of the
Okay.
value of the property, so that the down payment requirements are higher, right?
Okay.
And if it's 4 units or less, that is what's called a conforming loan, right? So
Okay.
it's sold off to a government entity, and can be sold off in the securitization process, right? And a conforming loan is very, very similar to just the loan you take to buy your house, right?
Okay.
If it's 5 units or more, that's technically considered an apartment, right? And then it's
Okay.
commercial financing. That is a whole other level of complexity. And so generally, I would say people that are getting started for the first time, they may want to stick with the fourplex, or single family home, twoplex, threeplex, fourplex. That is going to be just an easier experience to start with.
Right. Yeah.
Yeah. The other thing that maybe some folks who are watching might be thinking about is, well, they want to get in their first home and they want to become a rental property owner at the same time.
Right.
And that's called house hacking, right?
Yep.
So house hacking is the original definition, which was I think coined originally by Brandon Turner, who was one of the co-founders of Bigger Pockets.
Okay.
Is where you buy a multifamily property, you live in one unit, and you use the rents from the other units to help you qualify for the loan and to help pay your mortgage.
Right.
Housing is just a wonderful way to become both a homeowner and a real estate investor.
Yeah.
It's not great for everybody, right? But especially if you're getting started in your early career, can be a really wonderful thing to do. You can also do what I call house hacking 2.0, which is this is what my oldest daughter is doing, right? She bought a home early in the pandemic, and then she took roommates, right? So her roommates helped pay for the rent in the house. So that can also, you can use the existing home that you have to generate income in other ways. Like you could rent your parking space.
Okay.
So you need a chunk of change, right? This isn't just like buying your first home, right? To get to the point where you can save that amount of money, you've had a liquidity event. You want to make sure you've covered all your bases. You have your own emergency fund. You've maxed your 401k. You've got enough to exercise your options if you're going to exercise and hold them. You've got enough to pay taxes.
Right.
So you want to have all the basics covered before you would buy an individual property, right? Because a property it can be wonderful, but it's expensive. It's illiquid. It has carrying costs, right? It's not like you can just turn it back to Walmart if it doesn't work out. So
I swear I bought it here. You can take it back, right?
Yeah.
Yeah.
So you got to know what you're getting into up front.
Yeah. Okay. And actually, just to clarify what the down payment needs to be. So is it basically 20% no, like we're not getting back to subprime mortgage days whenever people are taking out loans with hardly anything down. So kind of what's the climate like with how much you have to actually put down with the down payment stuff?
So as an investment property owner, right, where it's not owner occupied, generally you're going to have to put 25 to 30%, depending on the length.
So it's just basically, hey, if you're going to do that, then that's
okay.
That's
it's there's loan programs in certain urban areas where you might be able to go as low as 15, but in general you should think at least 25% on an investment property.
Okay.
In a house hack, government-backed loans where you can put as little as 5% down, right? So that may be an option for some folks, right? If you're buying a duplex, you're going to pay mortgage insurance. So
Okay. So then if I guess just playing this out where it's like, okay, yep, I have that cash. I've taken care of all my personal stuff too. And then I have enough to get into an investment property. Then and I guess maybe I'll just keep playing it out where it's me and like I'm not handy. I don't want to do it myself. So then that's where it gets into having like a property management company come along too, right? Okay, so can you walk me through a little bit more of just like, okay, yeah, I have that part kind of what's the next steps here.
Okay. So I would say that, having your team in place,
Yeah.
at least part of your team in place before you start making offers on a property is going to be very helpful. And so
Okay.
uh, uh, think about who you need to help you with this transaction. So you need an investment friendly realtor, right?
Okay.
So somebody who's got experience with investors in your target area, right? Because real
Okay.
estate is hyper local, right? So
Right.
you want somebody who knows, who is investor friendly, right? Who knows what a property means to an investor, not just what a property means to a potential homeowner, right? And then hopefully somebody that person will work in conjunction with a professional property manager.
Okay.
Our property manager in our real estate business, we've had the same property management firm the whole time, and the lead property manager there, the one that runs the department, has been a really important part of our growing our real estate business, right? She's helped
Right.
us identify properties. We've gone on walkthroughs together to look for new properties, and discussed what needs to happen in this property to get it ready to rent. How much could you rent it for? Or yes, I like it. No, I don't like
Right.
it. I don't like this neighborhood. Love this
Okay.
neighborhood. Like this is how much I think I could get for it. So it's been super helpful. And then also just having somebody on the ground that can respond to tenant, needs and complaints is also
Right.
super
Right.
helpful.
Right. So
So
actually, so on a quick side note,
yeah,
so in that house hacking perspective,
yeah.
right? So if you're
hmm
neighbors with your renters, like
hmm
do people still use property management companies a lot?
Not so much.
Okay.
Sometimes I've seen it once in a while, right?
Uh-huh.
Where you have the tenant, the owners are living in one unit, and they contract with the property manager to manage the other units,
Right.
and their neighbors don't know that they're the landlord.
Oh, okay.
Right. I mean,
Okay.
so
So
you could,
they
I suppose, I mean, you could do it if privacy is really important to you, or you don't want to
right.
deal with toilets and trash, right?
Right.
Like
Right.
you could house hack and not be the landlord, right? But that
Okay.
that that obviously adds a level of expense.
Yeah, yeah, yep, yeah,
Yeah,
and I guess that's kind of whenever we're
yeah,
talking like pros and cons of it. That like, yeah, if you can do it
yeah,
yourself, then yeah, you're gonna save. You'll save on like not having to pay a property manager for
yeah,
stuff. But kind of
yeah,
to what we were talking about with the passive income, is that it's like, hey, but then you're basically taking on another part-time job where
yeah.
you're a mini property management company too.
Yes,
Yeah.
exactly. That's a great way to look at it. And so knowing upfront whether you want to do that or not.
Right.
I was recently working with a client, a physician who was looking to buy a home in a very expensive urban area. And I was trying to convince this client to house hack. And they were like, they're just, they were a doctor during COVID. They're done. They need
Right.
space, right?
Right.
They do not want to house hack. And I made that very clear to me that
Yeah.
was not, that didn't, the financial benefits did not matter, right? They wanted
Right.
some space. So,
Right.
um, real investor friendly realtor and
Yep.
property manager.
Yep.
So, uh, uh, if you're not going to manage the property yourself.
Right.
Now, there are, interestingly, in this internet age, right, there are actually more kind of turnkey offerings, right?
Okay.
So, some people may be familiar with roof stock, right?
Uh-huh.
So, you have investors, basically, or investors slash property managers, and they've bought properties, they've renovated them, they've put a renter in them, and now basically they're selling them to investors as kind
Right.
of a turnkey thing, right? So they might continue to manage the property, but they're going to sell the property to the investor. So it is possible to buy turnkey properties, right, with the property manager in place.
Okay. So it's kind of like the next level
Yeah.
in at being as passive as possible. So it's like I can be
Yes.
really involved, or I could get a property
hmm
management company, or this next level is I actually
Turnkey.
work with
Yeah.
this turnkey, where it's like I
hmm
am just the money behind it, right?
Yeah.
Okay,
Yeah. Literally the investor, the provider of capital. Yeah.
right,
Uh,
okay,
and and so the more properties that you have over time, right, that then even if you're using professional manager, I mean, there are decisions to make, right?
right,
You're making decisions about your portfolio. You're making financial decisions. The property manager has some authority, right, but is always going to be running stuff by you, right,
right,
to
right,
decide what to do. And then of course you have to manage the financials. um But in that first property, right, deciding, am I going to buy locally, and am I going to and manage it myself? Am I going to buy out of my geographic area, or even in a different state, right? In which case you definitely need to find a property manager.
Right.
And the challenges, I'm sure you can imagine, Mike, is if you try to buy something in a different state, right, you should at least go visit there, right?
Right.
Like you're gonna have to meet people and look them in the eye, and
Right.
and get a sense for the neighborhood. And it's hard, a property manager, to take you for just one property, right? Like,
Mm-hmm.
their typical client might have, more than four.
Okay.
So there's a balance between, is this large corporate property manager going to take you, for example, if you are only starting with one door.
Right. Right.
So just like any new, any entrepreneur, right? Like there's some bootstrapping in the beginning.
Right. Right. Okay. Okay. Yeah, that's all
Hmm.
really good. Okay. So
Hmm.
actually, I want to be cognizant of time because I think you have a hard stop at the top of the hour.
Hmm.
So here, let's just to kind of put a bow on it, and actually, maybe this is
Hmm.
a great dovetail into what we were just talking about having that right team. So
Hmm.
I always do a Reddit question at the end, and so I'm gonna
Okay, bring it on.
and yeah, Cynthia's not seen this, so I'm totally you know
Uh,
surprising her with all of this. Okay,
ah,
so basically, someone in the
uh,
personal finance subreddit says, "Hey, I'm looking for a fiduciary who specializes in real estate." So it's like I need someone who
uh,
knows real estate market, says they're willing to pay to like
mhm.
to learn about this stuff like first time homebuyer incentives, all that stuff, but they can't find anybody, right? And so it's like they're
Ah.
either getting just a regular financial planner, financial advisor that doesn't
Mhm.
know anything about real estate, which like whenever people talk to me about like, hey, I'm thinking about getting into investment property, then I'm like, hey, I'm going to be very transparent that like this isn't my jam. Like
Mhm.
I know like surface level stuff, but like it's not my specialty, right?
Mhm.
But so it's like either that or I have real estate agents with that their focus is on like selling the property, right?
Mhm.
So says what can this person do? Where can they go?
So this is, I'm going to say generally, and then I'm going to say specifically for this question. So in a general, for somebody looking for a fee only or fiduciary financial planner who works with real estate investors, of course, you can go to my website, which is reallifeplanning.com. But if you're looking to check out several people, you should go to our financial planner network, which is called the XY Planning Network. And
Uh-huh.
in the advisor search, you should put in the word real estate, and you're going to get 6 or 7 people that primarily work with real estate investors, different types of real estate investors. So no matter what you're looking for, right? Like if you're looking to do rental property, I have a colleague that does vacation properties. I have another colleague who does commercial property.
Mm-hmm.
So like shopping malls and things like that. So hopefully you'll be able to find somebody there and take a few people for a test drive. In this particular, or actually, just stepping back for a second, that
Mm-hmm.
one of my goals, having been a financial planner for a long time, is to teach other people to do what I do. Right. So
Yeah.
I'm working with a group of other planners right now, and we are developing some ways to do that. Right. So I do think more people are going to be owning direct property in the future, and we should, as a profession, we should be incorporating it into financial planning. So
Right. Right.
then this particular person looks like maybe they're a first time home buyer, right? And so they're looking to
Yeah.
get an idea about like how much could they really afford. Their lender probably wants to lend them more money than they really want to borrow, and so certainly talking to any fee only planner, right, about their true budget, right, and to do a little research on first time home buyer incentives, I think
Right.
could be helpful.
Yep.
And also maybe a financial wellness program at work, right? So if they work for a larger
Mm-hmm.
company that has a financial wellness program, they may be able to get some unbiased guidance there as well.
Right. Right. Yep. Yeah, that's definitely a benefit that is out there that I don't think people use
Hmm.
as much as they probably should.
Yeah. Well, they, they,
Yep.
they may not know it's there, right? But it's always worth asking your HR department if you have one.
Right. Yep.
Yeah.
Yep. All right.
Yeah.
Very cool. Well, hey, actually, I guess before I was supposed to do this like 50 minutes ago, but I didn't. So anyway, everything that you just heard is just general explanations and educations, not specific tax, legal, or investment advice. And so talk to your team before you make any decisions on any of this stuff. So okay, so just wrapping up. So first, thank you for joining and coming on. And for anybody that wants to learn more about you, where would they find you?
Okay, so you can find me at reallifeplanning.com. And if you look on social under that name, Real Life Planning, you'll find all our addresses. We have a video podcast, which hopefully we're going to get you on to talk about some tech specific issues in the future. And come and check it out. Lots of educational resources.
Okay. All right. Very cool. Well, again, I appreciate you coming on. It's been a lot of fun. For everybody else, I'll see you in a couple of weeks. Okay.
All
right.
Thank you so much,
Cynthia.
Mike.
All right. Bye.
Bye.